There are many signs that recovery is underway. Some are encouraging, some are just the opposite. And here's a trend that's going to take a little explanation. Leveraged loans are back in fashion, and banks are lending at what may be the fastest pace since the credit market debacle began in 2007. Let's bring in Bloomberg News reporter Jody Shen for more on this story, which I must admit we were talking during the break, a little bit more complicated than our time slot would allow, but we're going to do our best. What kind of loans are banks willing to lend right now?
Well, what banks are actually doing in the story that we recently did was that they're lending to the buyers of really somewhat risky loans, which is in turn allowing those buyers, hedge funds, other investment funds, to buy those loans at higher and higher prices while still making decent returns, 15–20% that they're looking for. And those loans, the leveraged loans, are things like what was used in the buyout boom, and they're still out there. They haven't gone away. And they're also using loans to people who are buying mortgage-backed securities as well.
It seems a little risky, but then it seems to the questions out there, if the risk is there, are lessons not being learned from the past?
Well, you know, there are lessons being learned in that the banks are being very careful when they lend to these investment funds. They're not asking them to put down 3% or 10% or 20%. It's more like 30, 40, 50%, and then they lend them the rest of the money to buy these riskier securities. And so people are probably more concerned about what it means for the funds and the markets who are taking up these offers from the banks than they are worried about the actual banks themselves. Although, as we've seen in the last 2–3 years, obviously things can turn around in the negative sense and get to a much worse place than people are imagining.
And what's being excluded from this? Treasuries and what else?
Well, there's long been, you know, even during the worst of times, lending from investment banks and even money market funds to people who are buying treasuries and agency debt and the mortgage-backed securities guaranteed by federally linked companies that, you know, would be considered pretty safe, and people have been able to leverage that throughout the crisis to lesser and greater degrees. And now we're getting to the dicier stuff that you may take a bigger loss on if there is a default, and whose values just move around much more quickly when things get hairy.
Well, deals are happening now, but how are they different from what was going on during the peak?
Well, one difference, I mentioned the fact that they are asking for bigger down payments when the investment funds are buying this stuff. They're also charging much more for the loans. For instance, in mortgage-backed securities, where they might be at the height of the boom charging nothing more than LIBOR for that loan to buy that mortgage-backed security. Now it's anywhere from 1.5% to 4% over LIBOR to get that loan. And also, they're being more careful about who they lend to. They're kind of being selective in terms of the fund managers that get this kind of leverage. They're looking for people who haven't blown up in the past, as somebody explained it to me.
Jody Shen, our Bloomberg reporter, and we should point out that your story on the terminal, along with your colleague Kristen Hahn's, leverage rising on Wall Street at fastest pace since '07 freeze. Jody, thank you so much. Appreciate it.
Thank you.